Hey there and welcome. Today we're going to pull back the curtain on something that runs our entire world, but that most of us never really think about. It's called fractional reserve banking. And trust me, it holds a pretty wild secret about where money actually comes from.
All right, so let's start with a really simple question. You walk into a bank and you deposit $1,000. What do you think happens to that money? Does it just get tucked away in a little box in a vault somewhere with your name on it, just waiting for you?
Well, here's the first surprise. The answer is no, not even close. The bank does not keep all of your money. In fact, they only hold on to a tiny, tiny fraction of it. And the rest? Well, the rest goes on this incredible journey that literally creates more money in the economy. And that right there, that's the big secret at the heart of modern banking. It's a system that makes everything possible, from getting a mortgage on a house to starting a new business. And it all kicks off with just that tiny piece of your initial deposit.
So what is this system called? It's fractional reserve banking. And honestly, the name kind of gives the whole game away, right? Fractional, meaning just a small part. Banks are only required to keep a fraction of your deposit in their reserves. And what about the rest? You guessed it, they lend it out.
Okay, so you're probably thinking, hold on a second. If banks are lending out most of everybody's money, how does that even work? Well, it's all thanks to this really fascinating concept called the money multiplier. And this is the real engine of the whole thing.
Let's just walk through a super simple example. So, step 1, you deposit that $1,000. Okay, now step 2. The bank has to keep, let's say, 10% reserve. So that's $100 they have to hold on to. Step 3, they turn right around and lend out the other $900. Now here's where the magic starts. The person who borrowed the $900, they go out and spend it. And boom, step 4, that money gets deposited into a different bank. So what does that second bank do? Step 5, they keep their 10%, that's $90, and they lend out the other $810. And as you can probably imagine, this just keeps going and going and going.
And what you just saw, that is the money multiplier effect in action. It's incredible. Your original $1,000 deposit didn't just stay $1,000. Nope. As it gets loaned out and redeposited over and over, it creates this massive ripple effect, actually increasing the total amount of money in the system. Pretty wild, right? So I get it. This probably has you thinking, why on earth do we do it this way? I mean, why not just have banks hold on to 100% of our money? Wouldn't that be safer? Well, yeah, probably. But the reason we don't is because this system serves a really, really powerful purpose for the economy.
So what is that purpose? Well, simply put, this system is the fuel for our entire economy. Think about it. It makes all that lending possible. The kind of lending we need for stuff we just take for granted. You want to buy a house? You need a mortgage. Somebody wants to start a business and create jobs. They need a loan. This system keeps money moving, which stimulates spending. It's the engine for economic growth. It's all about flow, not about just letting money sit still.
But, and you knew there was a but coming, didn't you? A system that's built on lending out money that isn't technically all there in the vaults, well, it has a pretty big weak spot. There's a risk, and it's a huge one. Yeah, exactly. What happens if everyone panics? What if we all show up at the bank on the very same day and demand our money back, right now? The simple and kind of scary truth is, the bank doesn't have it. That nightmare scenario has a name. It's called a bank run, and it's usually kicked off by fear. People get scared the bank is in trouble, that it might go under, and here's the crazy part. Because this entire system is built on trust and confidence, just the fear of it failing can be enough to actually make it fail. It can become a really scary self-fulfilling prophecy. Now, obviously, we've learned some pretty tough lessons from history, so there are some powerful safeguards in place to stop this from happening. Banks are heavily regulated, our deposits are insured by the government up to a certain amount, and maybe most importantly, we have central banks that can step in as a lender of last resort to calm a panic before it gets out of control. Okay, now we are getting to what is, for me, the most mind-bending part of this whole story. We've seen how a deposit can multiply through the system, but that leaves a really big question unanswered. When a bank gives someone a loan, let's say it's a $300,000 mortgage, where does that money actually come from? Are they just grabbing it from a bunch of other people's savings accounts? The answer is pretty stunning, actually. The banks create it. Seriously? They don't just move existing money from one person to another. When they approve your loan, they literally just type the numbers into your bank account. And just like that, poof, new money is created out of thin air.
It's just a digital entry. It didn't exist a second before.
And this is such a key thing to understand. The vast, vast majority of money in the world today is not physical cash. It's not the bills and coins in your wallet. It's digital bank-created money. And it gets created every single time a bank makes a new loan.
You know, a great way to picture this whole thing is like a big water tank. Think of deposits as water flowing into the tank. The bank keeps just a little bit of that water at the bottom, that's the reserve, but almost all of it is immediately piped back out as loans. And those loans are what water the entire economy, powering everything from homes to businesses. It is a system designed for constant flow, not for storage.
So let's just put it all together. Fractional reserve banking, it's this incredibly dynamic system. Banks use our deposits to create brand new money by making loans. On the one hand, that fuels all kinds of economic growth and opportunity. But on the other hand, it's all built on a foundation of trust. And it always, always carries that risk of a bank run if that trust disappears. And that leaves us with a really big, important question, doesn't it? We have this system that creates unbelievable opportunity, but at the same time, it carries this deep, profound risk. So it makes you wonder, how do we balance that amazing engine of growth with the very real danger of collapse? Where do we as a society draw that line?